Today on RoxomTV News, fighting explodes again between Thailand and Cambodia, and Trump says he's ready to stop a war with a phone call, which markets always love to hear. Russia and China fly nuclear-capable bombers near Japan, reminding Asia that regional stability is apparently optional this week. And back home, U.S. tax prosecutions collapse as enforcement priorities shift, raising a quiet question about who actually gets audited anymore. All that and more right now on today's show. Let's go. Good morning and happy Wednesday, everyone. Welcome back to another edition of Roxom TV News. We got a lot to talk about today, so let's get into our top stories of the morning. First up, we got Vladimir Zelensky is in Kyiv fighting a war with Russia and now also fending off Donald Trump questioning whether Ukraine is still in fact a democracy. On Tuesday, Zelensky said he is ready to hold wartime elections within 60 to 90 days if Ukraine's parliament signs off and if the United States and European allies help make them possible. He made it very clear he didn't love being lectured from abroad, saying the question of elections is for the people of Ukraine, not people from other states, even if they're partners. Trump had told Politico that Ukraine hasn't had an election in a long time and suggested it's not really a democracy anymore, glossing over the small detail that the Constitution bans elections during martial law. Even Zelensky's political opponents have repeatedly said a full national vote during active war would be a security nightmare and a gift to Russia. You still have millions of people displaced, soldiers on the front lines, and civilians under occupation, and somehow all of them would need a way to vote without turning polling stations into targets. Now, Zelensky said the two big questions are how to physically include everyone in a legal election and how to do it all while martial law is still in effect. The subtext here is quite simple. Ukraine doesn't want to look like a leader clinging to power, but also can't afford a chaotic election that fractures the country while Russian missiles are still flying. And now the whole issue becomes one more test of how much political pressure Kyiv can absorb from its allies while it's still trying to survive an invasion. It's a reminder that in wartime, the line between protecting democracy and performing democracy gets very blurry very fast. Now, and this matters because Ukraine's fight isn't only about holding territory anymore. It's about holding legitimacy in the eyes of the people financing its very survival. When a U.S. president publicly questions Ukraine's democratic status, that skepticism doesn't stay rhetorical. It ripples into AIDS debates, voter sentiment, and how long Western governments feel politically safe supporting Kyiv. Now, elections in this context aren't just a civic exercise. They're a signal to allies, markets, and adversaries about stability, unity, and resolve. At the same time, forcing a national vote while missiles are still flying risks internal fractures and security chaos that Russia would be happy to exploit. Now, the outcome here shapes not just Ukraine's future, but how long this war drags on, how costly it becomes, and how much uncertainty spills into energy prices, defense spending, and global risk markets beyond Ukraine's borders. And over on the other side of the world, we got fighting between Thailand and Cambodia, and it has intensified along their shared border. And now, President Donald Trump says he wants to step in and stop it personally. Artillery, rockets, drones, and fighter jets have been exchanged across more than a dozen locations along the 817-kilometer border, marking the heaviest clashes since a brief war this summer. Now, both governments accuse the other of targeting civilians, including strikes near homes, hospitals, and evacuation routes. Thailand's military says that Cambodian forces fired BM-21 rockets and used drones to drop explosives, forcing hospital evacuations in border provinces. Cambodia claims Thai artillery armed drones and F-16 jets crossed into its airspace and struck near civilian areas. Casualties are mounting in this situation. Cambodia reports 9 civilians killed, including an infant, and dozens of people wounded. Thailand says 5 soldiers are dead and more than 60 people are injured. Hundreds of thousands of civilians have fled border regions as fighting spreads across multiple fronts. Now, against that backdrop, President Trump told reporters that he would make a phone call to try to halt the fighting, referencing the ceasefire he helped broker earlier this year. It was actually about 6 weeks ago. Now, Thai officials pushed back quickly, saying the mediation cannot be improvised and must follow formal diplomatic processes. Cambodia's government says it wants peace and has signaled openness to talks, while Malaysia's prime minister says he is urging both sides to keep negotiating. Now, the immediate issue here is trust. You see, last month, Thailand suspended de-escalation efforts after accusing Cambodia of laying new landmines, a charge Phnom Penh denies. Now, for markets, this conflict matters less for scale and more for signal. You see, Southeast Asia has been one of the world's most stable regions, and open interstate fighting introduces a new geopolitical risk premium. Trade routes, manufacturing corridors, and regional supply chains all run through this very zone. Emerging market investors tend to react quickly to uncertainty, even when conflicts remain localized. Now, whether Trump's intervention cools tensions or adds unpredictability may determine how quickly risk stabilizes. For now, though, the region is watching to see if diplomacy catches up to the fighting. Now, the reason that this story lands beyond Southeast Asia is that even limited border wars can quietly disrupt systems people rely on without ever making front-page headlines for long. Thailand and Cambodia sit along key regional trade corridors that feed into global manufacturing, agriculture, and shipping networks. And when fighting spreads across multiple border fronts, insurers reassess risk, logistics companies reroute or pause shipments, and investors start pulling capital from the region, not because the war is global, but because uncertainty is contagious. And in an unconventional wild card like Trump publicly offering to intervene outside of established diplomatic channels, and you introduce another layer markets struggle to price. Stability in Southeast Asia has long been treated as a given, and once that assumption cracks, costs tend to rise quietly but persistently, showing up in everything from emerging market currencies to the price of goods moving through Asia-Pacific supply chains. And in Australia, well, it looks like their social media ban officially kicked off this week, and for millions of teenagers, it wasn't theoretical, it was immediate. You see, under new rules, anyone under the age of 16 is now prohibited from using major social media platforms. Now, that meant teens across the country were suddenly logged out of apps they use every day, cutting off not just scrolling and posting, but messaging, group chats, school communities, shared interests, and social lifelines that had quietly become part of daily life. On Instagram, many teen users got this notification due to laws in Australia that you won't be able to use social media until you've turned 16. Now, for a lot of kids, it felt less like a policy shift and more like the internet door slamming shut without warning. Now, as you can imagine, it's a hot topic in Australia. Check out the headline for the Courier Mail today. It says, "Today childhood will be rebooted." And that headline pretty much sums up the moment here. According to local reporting, many under 16s didn't just disappear offline, they migrated. As within days of enforcement, teens began flocking to lesser-known apps that aren't yet covered by the ban. Now, these platforms have been climbing Australia's download charts almost overnight, but that workaround is exactly what worries child safety experts and parents. Smaller platforms often lack the moderation tools, the reporting systems, and safeguards built into big social media companies. Or, in other words, the ban may not be ending online exposure. In fact, it may be just pushing people into darker, harder to regulate corners of the internet. And the rollout itself was far from airtight. Within hours, enforcement cracks were already visible. According to Sky News Australia, teenagers breezed past restrictions on day one simply by entering a new birth year, creating fresh accounts, or moving to platforms that hadn't been flagged yet. Australia's e-safety commissioner acknowledged the issue on Wednesday, saying teens slipping through the cracks would be eventually booted off. Now, eventually being the key word here, because meanwhile, teachers, mental health advocates, and youth counselors are raising other concerns. You see, for many adolescents, social media isn't just entertainment. It's where friendships live, identities form, and peer connection happens, especially for kids who already feel isolated offline. Cutting that off abruptly, networks, communities, inside jokes, shared culture could deepen loneliness or even push teens toward more precarious spaces with fewer guardrails. So while the policy is designed to protect children, critics argue the shock of enforcement may be creating new risks alongside of the old ones. So let's break this story down, starting with the market impact first. So from a market perspective here, Australia didn't just pass a youth safety rule. It created a regulatory precedent. You see, Australia's ban is one of the most sweeping restrictions on youth access anywhere in the world, and global investors are certainly paying attention to it. Once a developed Western economy enacts something this aggressive, other governments start asking whether they can or whether they should do the same. That introduces long-term compliance risk for global social media companies. Age verification systems aren't cheap, and user base uncertainty matters when growth projections depend on younger cohorts. Smaller, alternative apps may see some explosive growth in the short term, but with the real risk attached, if under 16 users continue migrating to lightly regulated platforms, download numbers may spike, but monetization, ad safety, and moderation costs could become serious problems. Now, many of these companies aren't built for compliance-heavy environments, and that creates volatility for investors betting on the next breakout social platform. There's also pressure on advertising models. Brands that rely on youth engagement, we're talking gaming, fashion, entertainment, may see reduced reach in regulated markets. That could force advertisers to rethink targeting strategies, potentially compressing revenue for ad tech companies and consumer brands alike. Now, at the same time, enforcement creates opportunity. Demand for age verification tools, digital identity services, moderation software, and compliance infrastructure is likely to grow as a result of this. And companies operating in that space could find themselves quietly benefiting from the regulatory shift. So while social media platforms absorb the headlines, a whole supporting ecosystem is moving underneath. And then, of course, there's the parents, and many parents here are welcoming the ban. Sky News talked with some of them. Let's take a look and see what they had to say.
How are you feeling about it? Is this a sense of relief? Will there be as many battles in the evening?
I'm not so sure. I mean, it's not a true ban. They can still access some of the accounts. They just can't have their own accounts. I'm full of admiration actually for the government making a step and trying to regulate a little bit, because the big tech giants are not regulating themselves and they do exactly what they want. So no matter how it plays out, I'm quite pleased that they're trying, and I think it's kind of a social experiment to see what happens next.
And we have a dad here of two very young children, so it's really going to affect them. What do you think? How are you feeling about it?
Well, as she said, I think it's a good idea because it'll keep the next generation off social media and really stop them ever starting those accounts.
Now, there is an argument that it should be up to the parents to decide, that the state's intervening, making all the rules. How do you feel about that?
I don't think I'm technically savvy enough to keep her off if she wanted to, so I think the government getting involved is a good thing.
Thanks, Australian parents. Now, polling shows that a strong majority of parents are in fact on board. We heard it here. Roughly 73% of parents of 9 to 12-year-olds support this ban. Even among parents of 13 to 16-year-olds, the group most affected, about 62% back the restriction. For many families, this isn't about censorship, though. It's about relief. Parents describe years of struggling to regulate screen time, online exposure, and algorithm-driven content that feels designed to keep kids hooked. To them, the ban isn't punishment, it's backup, a line they no longer have to enforce alone. So whether that relief lasts or turns into frustration as kids find workarounds remains to be seen. Now, let's take a look at the list of social media apps that have been, in fact, deactivated for those under 16. So this includes Facebook, YouTube, Instagram, Kik, Reddit, Snapchat, TikTok, and X. With the major platforms off limits, teens didn't wait around. They moved. One of the biggest winners so far is Lemon8, which is owned by ByteDance, the same parent company as TikTok. Now, the app blends Instagram-style visuals with Pinterest-like discovery and shot to the top of Australia's App Store downloads almost immediately. Another is Yope, a photo, video, and messaging app that surged to second place on download charts. And then, of course, there's Coverstar, a TikTok-style alternative that's reportedly spreading fast through school networks. The common thread here, though, is visibility. These apps aren't yet fully regulated under the new law, which makes them attractive escape hatches for kids, at least, for now. But again, the concern here is safety. Fewer guardrails, smaller moderation teams, and rapid user growth is not always a healthy mix. And of course, there's more to this. So many see this ban as a first step to surveilling people. At least Alex Jones from InfoWars thinks so. Let's take a look and see what he had to say.
The headline, Australia bans social media for under 16. That's not what that is. It's an internet ID where everybody gets internet ID, whether you're 85 years old or 16, and you got to go be tracked everywhere you go. That's the holy grail of the whole system.
Now, beyond social media, the bigger controversy may be what comes next. You see, starting December 27th, Australia plans to roll out sweeping age and identity verification rules across large portions of the internet. Under updated regulations tied to the eSafety Commissioner and the amended Online Safety Act of 2021, users logging into search engines, social platforms, and other online services may be required to prove their age. Now, that verification could involve facial age estimation, government-issued ID, bank-linked digital IDs, or other approved age assurance methods. The government says the goal here is simple: stop minors from accessing harmful content like pornography or extreme violence, and enforce the under 16 social media ban. But privacy advocates warn that the infrastructure required to do this could permanently reshape how people access the internet. Once identity becomes the gatekeeper, rolling it back is hard. And Australia's move has not gone unnoticed. Across Europe, from Denmark and Italy to France, Spain, and Norway, governments are revisiting age verification and youth access rules. Some are considering raising minimum ages. Others are pushing parental consent models. Denmark has already pledged to block under 15s from social media unless their parents approve. Norway is considering raising the digital consent age to 15. In Southeast Asia, Malaysia has announced plans to ban under 16s from social media starting in 2026. So global child safety advocates are calling Australia a live experiment. Some see it as overdue protection. Others worry that bans simply displace risk rather than reduce it. And among parents and teens worldwide, the debate is getting even louder. Is restriction the answer here? Or would better digital literacy, transparency, and parental tools work better? Australia has forced that question into the open. Now, what is my take on this, right? This whole thing isn't just about kids and screens, okay? It's about who controls access to the digital world. Is it the governments, platforms, the parents, or is it the users themselves? Australia chose to act decisively, and now everyone gets to see the consequences in real time. Now, whether this becomes a model or a cautionary tale may depend less on the law itself and more on what the kids end up doing next. I guess only time will tell. All right, we're taking a quick break here at RoxomTV News. When we're back, more of today's top headlines. Stick around. We'll be back after this quick message.
Security matters. Zappo Bank, the only way to bank your Bitcoin. Apply now at zappobank.com.
Wish you could grab cash without selling your Bitcoin? Of course you do. I do. And that's the reason Legit exists. You see, they're the global leader in Bitcoin-backed loans. We're talking over $9 billion issued since 2018 with a perfect record protecting client assets. Now you might be asking, Hank, what makes a Legit loan different? Well, you see, with custody loans, your collateral, it stays put. They don't go degen and lend it out for yield. There are no credit checks. It funds in under 6 hours, no monthly payments. You can repay anytime with 0 penalties. And for transparency grown-ups actually want, proof of reserves reports every 6 months, verified by a top accounting firm. The bottom line is that Legit lets Bitcoin holders unlock liquidity without selling. And you can check them out over at ledn.io/RoxomTV. That's LEDN.io/RoxomTV. Check it out. All right, everybody, welcome back to Wednesday's edition of Roxom TV News. Now, we're going to want to get into our top Bitcoin story of the day regarding GameStop's big bet on Bitcoin. Now, Bitcoin currently is sitting right around that 92K mark. We've seen some wild swings in the last couple of months. Now, with that being said, GameStop's $500 million decision to buy Bitcoin is now fully embedded in the company's earnings, turning a video game retailer into an unwilling case study in crypto volatility. It's in its third quarter report. The company disclosed that its Bitcoin holdings were worth roughly $519 million at the end of the quarter, reflecting an unrealized gain of about $19 million. That headline number, however, masks just how uneven the ride has been. You see, earlier this year, those same holdings briefly climbed to around $528 million before falling back as the Bitcoin prices retreated. GameStop made no additional purchases or sales during the quarter, meaning the swings were driven entirely by market price movements rather than company action. Now, the original investment dates back to May, when Bitcoin was rallying amid a more crypto-friendly tone from Washington and growing enthusiasm for corporate Bitcoin treasuries. That enthusiasm, however, has cooled off considerably since October. Bitcoin is now down roughly 30% from its recent highs following a sharp correction that wiped out billions of dollars in leveraged crypto positions. The pullback has hit several Bitcoin treasury companies and hard, including firms built almost entirely around holding digital assets. Now, Michael Saylor's company Strategy, long viewed as the flagship of the model, is now trading below the value of the Bitcoin that's on its balance sheet. GameStop is not in that position, but the market is clearly watching and closely. Shares of the company fell about 5% after earnings as GameStop missed analyst expectations and posted a year-over-year decline in net sales. Revenue slipped to $821 million, down from $860 million a year earlier, keeping pressure on the company's core retail business. But at the same time, GameStop has signaled it may deepen its Bitcoin exposure. The company recently raised $1.5 billion through a convertible note offering, with plans to allocate part of that capital toward additional Bitcoin purchases. That move would further tie GameStop's financial profile to the performance of the overall crypto market. Now, supporters see this strategy as a long-term treasury hedge aligned with Bitcoin's fixed supply and growing institutional adoption. Critics, however, argue that it adds unnecessary volatility to a business already facing structural headwinds. Either way, though, GameStop has crossed a threshold. Its earnings are no longer judged solely on retail execution. They are now, at least in part, a quarterly snapshot of where Bitcoin happens to be trading. Now, what this really shows is how Bitcoin has a way of hijacking the narrative once it's on the balance sheet. For GameStop, the Bitcoin position is already large enough that market swings can meaningfully color how investors read the earnings report, even when the core business is struggling. That shifts the company's risk profile overnight, from a turnaround retail story to a partial macro and crypto bet it doesn't fully control. Now, for everyday investors, it's a reminder that when companies adopt Bitcoin treasuries, you're not just buying exposure to management execution anymore. You're buying exposure to Bitcoin's volatility, whether you signed up for it or not. And across the world, Japanese fighters were scrambled this week as Russian and Chinese bombers conducted joint patrols near Japan's airspace. Now, the patrol involved 2 Russian Tu-95 nuclear-capable bombers and 2 Chinese H-6 bombers flying coordinated routes from the Sea of Japan into the Pacific. 4 Chinese J-16 fighter jets escorted the bombers as they passed between Okinawa and Miyako Island through international waters. Japan also detected additional Russian aircraft, including an early warning A-50 plane and an Su-30 fighters, operating closely nearby. Now, Japan's defense minister said the joint flight was clearly intended as a show of force. South Korea confirmed that several Russian and Chinese aircraft entered its air defense zone during the same operation. China later confirmed the patrol, describing it as part of a routine cooperation with Russia. Now, unlike past statements, Beijing did not emphasize that the flight was not aimed at any third party. So the timing in this, it matters. Japan has taken on firmer lines on regional security, with Prime Minister Sanae Takahashi recently signaling Tokyo would act if a Taiwan conflict threatened Japan. China strongly opposed those comments and has increased military pressure around Japan in recent weeks. The patrol also follows incidents where Chinese aircraft allegedly locked radar on Japanese planes, claims Beijing disputes. For the region, the signal is about coordination. You see, China and Russia have steadily expanded joint military exercises across East Asia, including missile defense drills and naval operations. Now, for markets, these maneuvers don't change fundamentals overnight, but they raise the background risk level considerably. You see, investors watch Japan closely as a stable anchor in Asia. Any perception of escalating military friction can increase volatility in regional currencies, equities, and defense stocks. And Japan's alliance with the United States remains firm, and Washington reiterated its commitment to Japanese security. But as great power coordination becomes more visible in the skies, the margin for miscalculation narrows. And that tension is now part of the global risk landscape, whether markets like it or not. And what makes this consequential is not a single flyover, but the pattern that it reinforces. You see, coordinated Russian and Chinese patrols near Japan raise the baseline level of geopolitical risk in a region that markets usually treat as predictably stable. Japan isn't just another economy. It's a cornerstone of the global supply chains, currency markets, and U.S. strategic presence in Asia. And when military signaling intensifies around that hub, investors quietly reprice risk, even if nothing breaks today. And the closer these maneuvers creep toward flashpoints like Taiwan, the more sensitive everything from shipping insurance to semiconductor stocks become to one wrong move. We're going to take a quick break here at RoxomTV News, but when we're back, we have more of today's top stories, so stay tuned. You won't want to miss them. We'll be right back. Are you interested in effortlessly growing your Bitcoin portfolio? I sure am. And the Bitcoin credit card by Gemini earns you Bitcoin back on every purchase. You can use it like any credit card. You can buy lunch, gas, or your weekly groceries, and you'll earn up to 4% back instantly in Bitcoin or one of over 50 other cryptos straight to your account. All that with no annual fee. And right now, you can grab a $200 Bitcoin welcome bonus. It is the easiest way to start building your Bitcoin stack. Just go to Gemini.com to learn more. All right, welcome back. It's Wednesday here at RoxomTV News, and we are in the midst of going over the top stories of the morning. And our next guest here is, not really a guest, but our next person here is very familiar to all of you, as we're talking about Elon Musk, as he is now looking back at his big political side quest running Trump's Department of Government Efficiency, or DOGE, and basically saying, yeah, maybe that wasn't the best use of my time. See, on a podcast with former Trump advisor Katie Miller, Musk said that DOGE was a little bit successful and somewhat successful, but admitted that if he could rewind, he'd have just focused on his companies instead. You see, DOGE was created by executive order to slash federal spending, shred headcount, and shut down programs that Musk and his allies viewed as being wasteful. It promised up to $2 trillion in annual savings, claimed more than $200 billion on its own website, and then disbanded 8 months early without offering a detailed public breakdown of those numbers. In the real world, the initiative triggered protests, vandalism of Tesla showrooms, and a slump in Tesla sales as some customers decided they didn't want a president's favorite billionaire as their car brand. The political romance didn't exactly last either. You see, Musk and Trump had a very public falling out over a massive tax and spending bill, trading shots online after months of standing shoulder to shoulder at the White House. Now that things appear to be patched up again, Musk is reframing DOGE as a kind of high-speed experiment in shrinking government with mixed results and plenty of blowback. For investors, the takeaway is less ideological and more practical. Every hour Musk spends in Washington instead of on Tesla, SpaceX, or his other ventures carries real business risk, especially when it drags the brand into polarizing political fights it doesn't need. And in his own hindsight answer, no, I don't think so, is a pretty concise verdict on whether the experiment was worth the cost. Now, what this really highlights is the cost of distraction when a public company's CEO steps fully into politics. Musk isn't just a commentator. He runs businesses whose valuations depend on execution, focus, and consumer trust. And when he became the face of a government cost-cutting crusade, the blowback didn't stay in Washington. It showed up in Tesla sales, brand perception, and investor anxiety about whether leadership attention was drifting. His hindsight admission isn't about ideology so much as opportunity cost. You see, markets tend to forgive bold bets that work, but they're far less patient with side projects that generate controversy, unclear results, and reputational damage, especially when shareholders are the ones left holding the volatility. And in other news, federal tax prosecutions in the United States have fallen to their lowest level in decades as the Trump administration reshapes how it fights crime. According to a Reuters review of court records, tax prosecutions dropped more than 27% this year compared with last year. Now, the decline coincides with deep staffing cuts across the Justice Department and the Internal Revenue Service. The Justice Department dismantled its centralized tax division, and officials say at least a third of its criminal prosecutors quit rather than be reassigned. At the same time, the IRS cut more than 10% of its criminal investigators in the first half of the year. Now, many of the remaining agents were redirected away from tax enforcement and toward immigration cases and street patrols. In Washington, IRS agents have even been deployed alongside local police as part of a broader federal push to combat crime in the Capitol. Now, the shift has had a ripple effect across the justice system. More than 1,000 attorneys have left U.S. attorneys' offices just this year, draining experience in complex white-collar cases. Experts warn that while criminal tax cases recover only a small portion of the nearly $700 billion collected less than owed each year, prosecutions serve as a deterrent. Without that threat, officials fear cheating could rise. And the Trump administration officials have argued that tax enforcement was previously politicized and say other crime priorities deserve more focus. They point to the staffing levels ahead of the next tax season and insist that enforcement capacity remains intact. But internal discussions, according to people familiar with them, made clear that tax cases were no longer a priority. High-profile cases underscore the shift. Crypto investor Roger Ver avoided a conviction this year through a deferred prosecution agreement that allowed him to pay nearly $50 million to settle tax allegations. For taxpayers and markets, the message is subtle but important. Enforcement isn't disappearing, but its center of gravity is clearly moving. And whether that trade-off changes behavior may only become obvious after the next filing season. Now, the bigger implication here isn't about sympathy for tax cheats. It's about incentives. You see, when enforcement drops this sharply, behavior adjusts, not immediately, but quietly over time. Businesses, high earners, and sophisticated flyers start recalculating risk because the odds of scrutiny are part of the system. For markets, that matters because tax compliance feeds directly into federal revenue projections, deficit math, and ultimately interest rate expectations. And for regular taxpayers, the concern is fairness. If enforcement tilts away from complex white-collar cases, the burden doesn't vanish. It just shifts toward the people who can't afford creative accounting. Watch out for that one. And down in the state of Florida, Miami voters have elected Eileen Higgins as their next mayor, ending nearly 30 years of Republican control of City Hall. Now, Higgins defeated Republican Emilio Gonzalez in Tuesday's runoff with roughly 59% of the vote, becoming the first Democrat to hold the office since 1997. She also makes history as the first woman elected mayor of the city of Miami. Now, while the race is technically nonpartisan, the campaign functioned as a clear proxy battle over national political currents. You see, Gonzalez was backed by high-profile Republicans, including Donald Trump, and leaned heavily into themes aligned with the post-2024 Republican agenda. Higgins, by contrast, drew support from Democratic organizers, labor groups, and immigrant-focused grassroots networks. Her campaign centered on practical issues facing the city, including rising housing costs, affordability pressures, and restoring confidence after years of political scandals. Miami's cost of living squeeze was a dominant issue, particularly for renters and service workers who have been priced out of neighborhoods they once anchored. Higgins also emphasized improving city services and rebuilding public trust, positioning herself as a stabilizing figure rather than an ideological crusader. And the result surprised some observers given Miami's recent rightward drift in national elections, but local dynamics proved decisive. Voter turnout surged in heavily immigrant and working class areas where concerns over affordability and immigration enforcement played a larger role than national party branding. Now, Higgins' win is already being read as a symbolic check on Trump-aligned politics in a city that has often been treated as reliably conservative at the municipal level. But at the same time, it underscores the growing divide between national voting patterns and local governance priorities. For markets and investors watching South Florida, the implications are measured rather than dramatic. Municipal leadership affects zoning, development approvals, and infrastructure investment more than macro policy. Still, a shift in tone at City Hall could influence housing development strategies and public-private partnerships. Higgins now inherits a city facing real constraints, from affordability pressures to infrastructure demands. And her mandate is clear. Voters chose change, and the test is now whether that change translates into tangible results. We're going to take a quick break here at RoxomTV News, but when we come back, we're going to take a look at the Bitcoin price one more time and break down the numbers in our market rundown. So stay tuned as we're going to be talking about what Bitcoin is doing now and where we think it's going next. We'll be right back. All right, welcome back to RoxomTV News. We're going to get quick into our market rundown this morning and see what the Bitcoin price action is looking like. Currently, we can see Bitcoin is hovering around the mid 92K region. And remember, we have seen a lot of volatility in the last couple of months. Just back in October, we reached new all-time highs around the 126K mark. We came crashing down to the low 80s, but we're starting to see some stabilization happen in the markets. We do have some knowledge of a likely Fed rate cut happening, and it certainly appears that that is being priced into Bitcoin's current levels. But right now, let's jump into the charts themselves and see what the market is actually doing, okay? So not what Twitter is just yelling about. So currently, Bitcoin is sitting around that mid 92,000 mark. Sentiment, though, is still feeling a little shaky, and the headlines are feeling quite loud. So these charts that we're looking at are what is going to help us separate the noise from the actual structure. And I'm going to walk you through three things today. funding rates, ETF flows, and where we actually are in the broader cycle. And as we go, I'm going to draw directly on these charts so you can follow exactly what I'm saying. So the first chart we're seeing here, we're going to start with, is the funding rates, because this is where leverage always tells on itself. The white line at the top that we're seeing right up here, okay, that is Bitcoin's price. The green and red bars that we see below show who's paying who in perpetual futures. Now, when funding rates are high and positive, the longs are crowded and they are paying to stay in. But when funding drops towards zero or goes negative, leverage gets flushed and weak hands are forced out. Now, here's the key structural thing that I want you to notice. So right now you can see that every funding spike is smaller than the last one, right? We got one here, a little smaller here, and then smaller here, all right? Which means less leverage, less froth, and more caution. That is not the sign of a market topping. This is the sign of a market resetting. Now, look at these moments that are down here, okay? These are the spots right down here. You see those? Those are the spots where sentiment flips bearish and leverage gets wiped and price often stabilizes or bounces afterward. Right now, funding is drifting lower again. We can see it, right? It's all coming down this way. That doesn't mean panic. It means the market is still clearing excess leverage. And historically, funding can dip negative multiple times before real bottoms truly form. So if Bitcoin pushes a little lower and funding flips negative again, that wouldn't be a total shock. That would actually be consistent with past resets. All right, so next up, we're bringing up our second chart of the day. This one is our Bitcoin ETF daily flows chart, all right? So we're moving on from leverage to real money here, and this chart shows the total Bitcoin ETF flows in dollars. The green bars are inflows, okay? So we see these green inflows. The red bars, though, are outflows, and yesterday matters, okay? We just saw $152 million in net inflows, and that's the biggest since the November 21st capitulation, okay? Now, that is not FOMO buying. This is institutions cautiously stepping back in the pool while sentiment is still mixed. Now, I want you to notice something important here. Price hasn't ripped higher, but the ETF inflows have turned positive anyway. That is how bottoms usually form. Quietly, slowly, and before confidence officially returns. Now, if we keep seeing inflows build over the next few sessions, that tells us ETF buyers are absorbing supply rather than chasing momentum. And that's constructive, all right? Now, we're going to our final chart of the morning. Okay, so I want to, this is our Bitcoin cycle extremes oscillator. So zooming out to the big picture here, this chart blends 8 different on-chain and technical metrics. We're talking the MVRV, the SOPR, the Puel, funding, reserve risk, all designed to tell us when Bitcoin is overheated or washed out. In prior bull cycles, you'd see long clusters of overheated signals near cycle tops. That's never happened this cycle. Instead, let's look at what just occurred, okay? So what we're seeing here is I want to take a look at the cool-off zones. That's the key takeaway. So despite trading above 90K, right, the market internally looks neutral to cooled off. And that tells us 2 things, okay? First, this has been an unusually disciplined bull cycle so far. And second, there is real demand underneath the market, even with heavy selling from long-term holders. That's absorption and not distribution. So now the question is, Hank, what does this all mean? So let's talk about it. Let's get to camera 1 on me, guys. So when you put this all together, funding rates are low and still unwinding leverage. ETF flows are quietly turning back on cycle metrics and show we are nowhere near being overheated. And you add in the Fed decision shifting macro liquidity and the possibility of quantitative easing ending and QE starting again, or quantitative tightening ending and QE starting again, and suddenly this market looks patient and not broken. So the level bulls want to defend is the true market mean around $81,300. We saw us take a dip back to there only several weeks ago, but now we're back up into the 90s again. So as long as that level holds, this remains a reset and not a breakdown. And that's the real story hiding behind the volatility we're currently seeing. All right, gang, it looks like it's that time. We are wrapping up with another show here at RoxomTV News. But guess what? We're back tomorrow for the same, and we've got an especially exciting one for you as we are going to be joined by one of the sharpest minds in the market space, Cedric Jungelman, one of our favorite guests on the show, to break down the top news and make sure that you're informed with everything that's going on, and maybe more importantly, why it matters to you. So if you haven't already, do the thing. Make sure to like, follow, and subscribe to Roxom TV, Roxom TV News, and me, and Hank at Roxom TV on your platform of choice, and we'll be back with more of the same tomorrow. So until then, have a great day, stay safe, stay informed, hodl on. I'll see you guys tomorrow.